Hello, everybody. My name is Richard C. Wilson, founder of the Family Office Club, and I've got with me here today my friend Dr. Forrest Bryant from the High Speed Alliance. Welcome, Forrest.
Hey, Richard. Thank you for having me as always. Appreciate you.
Sure. Yeah, appreciate it. And you're one of probably 7 people that, besides my clients just asking me for more information on tax efficient investments, I've watched you invest your time and energy in your community into becoming much more intelligent and sophisticated very quickly over the past 3 years on this area of tax efficient investing. So I have to thank you for that. That's, in part why we're doing this series, is watching you grow in this area. And I think one of the most interesting topics that we've done so far is today's interview on qualified small business stock, which we hope to learn about from you. And the only thing I know about this is that I've heard at your event and one other that if you invest in certain types of small businesses or operating companies, and if they fit a certain criteria, then your gains may be protected from taxation. And that's as far as my knowledge goes. It's as deep as it goes. And I think there's probably some other investors who are at that same level of, ignorance, I guess you could call it. So I'm just hoping for you to help us kind of fill in the lines here.
Yeah, well, thank you, Richard. Appreciate you having me. Thanks for the. I'm in the top 7 on that. That's I like that, and I know you have a deep Rolodex. So thank you for that. So just I guess who is this important for? So QSBS, it stands for Qualified Small Business Stock. This was enacted into legislation at section of the IRS code 1202, was put into place in 1993. And so a couple things that you need to know is what is a qualified small business, and then obviously talk about qualified small business stock. So what is a qualified small business? They're very specific about what that is. So number one, it's got to be a U.S. corporation, and it has to be a C corp. So I guess let me back up just for a second. Who needs to really pay attention to this? If you are a founder of a small company and you're going to be raising capital, or if you're an angel investor or private equity venture capital investor and you're looking at early stage investments, you really need to pay attention here. So it's got to be a C corp. So immediately that's going to knock out a lot of companies. You got to have revenues under $50 million. That's usually not a problem for a startup. And there are a lot of different types of businesses that do qualify for this. So what's the magic of this? If you are an investor investing into a qualified small business, your capital gains can be the gains. You can have an exemption for up to 10 times your investment. So basically, what that means is, let's say you are investing into a qualified small business. Say you put in $100,000. So if that $100,000 goes 10x, if you make $1 million on your $100,000 investment, then you're not going to pay any federal taxes on that investment. So I mean, that's huge. A couple other things that you need to know: there's a 5-year lockup. So you do have to hold these shares for 5 years. And one other thing that's really critical here is those shares have to be issued at original issuance. And so that's a real big one too. So basically what that means is, and sometimes you'll see this with some of the later stage companies, if there are privately held shares that are resold, like on the secondary market. So if you're playing in the late stage, pre-IPO, like on the private side, those shares typically are not going to qualify because they're, I know, and I'll give a few examples of some things that we've kind of run through with that. So hopefully that kind of gives you a little bit of an overview of what we're talking about. So let me give you some examples. So early stage. So we have invested in several early stage companies, US C Corps, purchasing the stocks at original issue. There's a 5-year hold. And if those go 10x, then, we're looking at, a 10x exemption through this section 1202. So make sure if you're an investor and you're looking, make sure it's a C corp. So here's a story. This is a real life example. We had one of our companies that we were looking at was an LLC. That's the most common setup. Most startups are LLCs when they start. You can convert. And I don't know, did I give my disclaimer on the front? I'm not a CPA, so let me just back up. Not a CPA. Make sure anything that you hear today, if you're a founder or if you're an investor, make sure you check with the securities attorney on this and a CPA to make sure, because if you are an investor and you're looking to invest, you definitely want to make sure that, you need to be knowledgeable if it's a qualified small business. So an LLC can convert to a C corp, and we've seen that. We've had one of our companies that we were looking at, they were starting to raise capital and they started getting bombarded with these, are you QSBS eligible? Are you a qualified small business? And they were not, because they were LLC. So they changed to a C corp, and that opened up the ability to get some more funds. I mentioned the late stage. So a lot of times questions on the late stage when somebody's getting ready to go public, the shares are resold from employees. A lot of employees get paid in stock, and so a lot of times they're liquidating some of those ahead of an IPO. That's not going to qualify. I think one other comment I was going to make, just from a real life example, a lot of investors invest with convertible notes in startups. So if it's a C corp and it hits all the qualified small business headings, a convertible note can be eligible for qualified small business stock exemption. However, the 5-year clock does not start until conversion. So an example, we've got like a real life example, doing a convertible note. It may be, maybe it's a year or two before it converts into stock, and then your 5-year window starts from there. So I guess one other thing I'll say, and this is the most important thing as far as taxes, invest with Roth accounts anytime you can, because then you have an unlimited tax exemption. Anytime, all the things that we talked about, you can have an unlimited tax exemption investing with tax-free accounts.
You mean unlimited in terms of like, well, it was protected from taxation in the beginning, and now also it won't be taxed on the back end because you're protected within that growth? Or when you say it's unlimited protection, what do you mean by that exactly?
So let's say I'm investing in a qualified small business. It's a C corp, it's a startup, everything checks the boxes. And I'm making a decision as an investor. Do I want to put $100,000 in this with cash, knowing that I'll have a 10X exemption? Or do I want to invest from my Roth IRA or my Roth 401k? If I've got this money over here and I make the same investment, it can go 1,000X, 10,000X, and I'm not going to pay any tax on that money, because it's an after-tax investment.
It's interesting. I mean, part of me thinks that this could be like potentially abused or used in in a way that wasn't planned, in terms of like somebody could start an SPV as a corporation and be like, oh, we're going to buy shares of Tesla within this corporation, or a share or crypto, or we're going to buy something else that's less risky, and it's really an SPV, but it's under this qualified small business stock. Is that disqualified because it's not a traditional operating business? Or can you start a C corporation whose sole business is to invest the assets of its investors through an SPV? Because I would guess it would be abused if that was possible.
One of the stipulations is 80%, because they try, they're ahead of you.
Right, I'm sure. Yeah.
The operating business, 80% of their assets have to be in an operating business. It can't be an investment company. So it has to produce something. It has to be a technology company. It has to be manufacturing. It has to be doing some sort of services. It can't be just a pure investment company.
Right, makes sense. But I would guess that you'd be able to, like, we're looking at a chain of medical clinics. They're doing about 8 million a year in revenue in the Midwest. We're looking at a manufacturing company in your neck of the woods, actually. And if what we're looking at is the bonus depreciation on equipment in both cases. But if you layered this on top of, okay, well, they might need to convert to a C corp before they raise capital.
Right.
And that way it will be an initial offering of shares at that point as they emerge as a C corp. But you also combine this with having that bonus depreciation tax write-off for investors on the front end. but also on the back end, they're protected as long as they hold for 5 years, and et cetera. There's an ability to stack a couple of these tax strategies on top of each other still, right?
Yeah, I think so. Getting into, if you're a stockholder, I don't know if you're going to be, I mean, there's the company's going to benefit from the, bonus depreciation, but I don't know that the stockholders directly would be able to take advantage of that.
Right.
But they would, as far as the, the company having those. I don't know that they would get they're not going to get the flow through tax benefits that they would if they were an LP in the company versus being just a stockholder.
Right. Being like a passive stockholder versus like a more active equity partner.
Right.
Type difference between the two. Okay, great. I know you have to run here in a minute. Is there anything else you want to add before we wrap everything up?
I think I hit the main points. I would say, if you're a founder, check with your securities attorney. And this is for founders that are considering this. A lot of savvy LPs are understanding this and they're looking for it, especially if they're investing with cash. And if you're an LP, if you're an angel investor, or if you're looking at an early stage startup, if you're looking at doing a convertible note or doing stock in a company, make sure if it's a qualified small business, and if it's not, and a lot of times, I mean, we get some really early stage opportunities, so. It's a good time to mention it to the founders, because sometimes the founders don't always know this. I mean, it's not all that well known, and so a lot of times they'll kick off as an LLC, and then they kind of come back and try to change horses. So getting them to a C corp and making sure that they go through the checklist to make sure that they're there is important.
Right. Makes sense. Okay, great, awesome. Well, I appreciate you doing this interview here today, and of course, if anyone needs referrals over to tax advisors, tax attorneys, tax experts, Forrest and I both are well connected there. And if anyone would like to get in touch with Forrest, just please let me know. We chat pretty much every week or two, so happy to make a connection to him and his group at the HSA. So thank you, Forrest.
Thank you, Richard. Thanks for having me.
Yep. Take care.